All right, Raheem, this is going to be a very interesting episode. I know there's a report that's done every 2 years, and we're bringing in Sun Life, guests from Sun Life, our first time on the savings side. So tell me about why you're excited to have these folks come in.
Yeah, so Caroline, in the retirement savings industry, the Sun Life Design for Savings benchmarking report, as you said, every 2 years, they do a really good job. We get a ton of data on plan design, on the way members are investing, on what investment categories they're choosing in terms of the menu of investments. So there's a plethora of data that they have available. And what makes it great is they're the largest player, right? So they're looking at millions of members worth of data. So it's highly reliable. They do a good job of segmenting all of it. So I'm really excited to talk to them about the inner workings of the report.
Great. Well, let's bring them in. Thank you both for joining us. Today we've got two guests from Sun Life. We've got Joe Dominicis and Jackie Patel. Let's start off by introducing yourselves a bit here. Joseph?
Thanks, Carolyn. Great to be here. I'm Joseph Dominici, or Joe, as most people call me. I'm recently joined Sun Life as Vice President Market Development for our GRS business, but I've spent 25 years in the retirement space. I'm an actuary by background, many years as a consultant and on the advisory side. So it's great to be here to talk about an area that I'm passionate about.
Thank you, Carolyn. And I echo Joe's comments. Very excited to be here. It seems like 25 years is the common number of years here. I've been here as well in GRS for over 25 years at 3 different organizations. I have been at Sun Life for almost 7 years now. And in the latter part of my career, I've actually spent pretty much most of my time in marketing communications. So I do lead the marketing and communications team at Sun Life, specifically in GRS.
Perfect. And one thing that we've been doing recently, Raheem and I, as we welcome and get to know our guests, as everyone knows, we're talking to employers today. We're talking to business owners that are, looking at savings plans for their plan members. But we like to have a little bit of fun around here and get to know our guests. So if you don't mind sharing, let's talk about, what do you like to do for fun? What's an interest of yours outside of work that brings you happiness? And I will start with Jackie.
Well, everyone that knows me, I've developed a passion for golf. So I'm anxiously waiting for summer to start. It's been a long time now, and I'm just looking every day for the golf courses to be open. So it's a form of meditation for me. It just gets my mind off of things, and I always say there's no part-time golf. Either you're in it or you're not, because 18 holes is a long time for just part-time golf.
So true. So true. Joe, what do you like to do for fun?
Well, I have 3 children, and so I end up spending a lot of time with them, which is great. I really enjoy that. 2 of them are in high school now, so they're pretty busy, and they have less and less time to hang out with dad. But I also enjoy cycling in the city. I've cycled to work most of my career, and I'm an avid swimmer. Always enjoy that. When I retire, it'll be somewhere near the sea for sure.
Excellent. Raheem, any new hobbies as you look forward to the spring and summer with your also large family?
No new hobbies. Same old. I'll kind of draw a parallel to Joe and Jackie. So as the audience would know who listen, I have 3 kids as well, 3 boys under the age of 10. So we're very busy. And Jackie, despite 3 kids, you'll be happy to know that I play golf twice a week minimum. So there is no rest for the week. And as you said, golf is either full time or no time. So just like you, I'm on the app, I'm on the Weather Network, just trying to figure out when we can get the season going.
Nice. Nice. Well, my new, I guess, goal this year is to successfully continue balancing on a paddleboard on Lake Erie. So that's what I'll look forward to. So let's dive in. We're here to talk about savings plans and some of the great information that you've brought to us today. So let's start with the big picture. Canadian employers, they put considerable effort in establishing workplace savings plans. How does a workplace plan align with an organization's broader strategy, would you say?
I'll start, Carolyn, if that's okay. Throughout my career, so the question that gets asked often is, hey, is financial security and financial wellness an employer responsibility? And my view has always been it's actually an employer opportunity for a couple of reasons. The sort of accepted now that financial well-being ties into mental well-being and overall well-being, and you know financially secure employees are more productive and engaged and just more loyal to an organization. So that's one. But the other piece is an attraction and retention piece for the employer. If you step back and think about it, a major reason why employees work for employers is financial security, right? They want steady income, security, so they can buy homes, take care of their children, do the things they want to achieve it in their lives. And so the retirement program, in my view, is a component of that sort of total rewards package that actually an employer can do better than an individual can do on their own for a variety of reasons. And I think there's obviously the component around design and governance and management. Those are all very important. But the third piece is actually communication to the employee, ensuring that employee knows how to optimize that program. And if that's done really, really well, what I found is the cost to the employer of sponsoring those programs is actually less than the value. The employee values it more than the cost of the employer. So it can be a sort of competitive advantage when done effectively. So to me, definitely an opportunity and a competitive advantage for an employer as part of a total rewards package.
Anything you'd add there, Jackie?
No, I absolutely agree, and happy to discuss some of the outcomes that will contribute to that.
Perfect. So Jackie and Joe, as we mentioned earlier, our audience is the plan sponsor, and on our side, on the advisor side of things, when we meet with plan sponsors, a lot of them will hear the word pension, and their mind goes to DB, and there's a little bit of fear naturally with historically the way things have ended up. But I'm wondering if you could kind of level set for us and provide us with a little bit of detail around the Canadian pension system. Now, we know Canada is one of the largest players, along with the UK and Australia and obviously the US. But if you would be kind enough to kind of break down the DB versus DB type environment and how that all fits in, I think that would be a great place to begin.
Yeah. So why don't I start, Jackie? It's a great comment, Raheem. Like, I don't know if people realize how big the Canadian sort of pension structure really is. It's over $3.7 trillion US dollars most recently, so over 5 trillion Canadian dollars. It's the second largest in the world next to the US. So, but more importantly, I think it's one of the best systems in the world when you factor in all three components, and that includes the government-sponsored programs, so our Social Security Network, CPP, QPP, the employer-sponsored programs, which our listeners will be most interested in, and then personal savings. And so when you optimize all three together, the system provides a resilience and a unique blend of different components to provide the right outcomes for Canadian retirees. When we look at how we compare globally, the DC sort of cap retirement savings component of the Canadian landscape is about 40 to 45% of those assets. So a significant component, much less when you compare to, say, Australia, where the DC cap component is 90%, or the US, where it's over 70. Part of the reason for that in Canada is what we call the Maple Eight. So 8 big Canadian DB pension funds, CPP, QPP, OMERS, HOOP, plans like that make up a significant portion of our retirement assets. But the DC component in Canada is the fastest growing segment or component of the system, and it's a major component of individual savings and individual sort of retirement planning. So an important component and an increasingly important component to the sort of overall financial well-being of Canadians and their retirement readiness.
Yeah, and just for the audience, we take it for granted our jargon. So CAP would be capital accumulation plan. So think about that as a DC plan, a RSP, a DPSP. basically
TFSA.
anything non-DB would funnel into that. Just wanted to make sure
Yeah.
we hash that out.
And that's workplace, Raheem, as well as individual savings within a group, within an RSP, an individual RSP or TFSA, or other sort of retirement earmarked assets.
So, Joe and Jackie, I have to tell you, I was so excited to have you come on our podcast show today because Raheem is the one that told me we've got to get them in here. We've got this report that I read year after year, Sun Life's designed for savings. So let's talk about that. I understand it analyzes over 1.5 million employee plan members. So tell me what the big deal is about this report. Why does Raheem tell me we have to talk about it? Why is it so important to employers, to advisors, and actually to the market?
Well, I can certainly comment on that. Raheem, you're not the only one. Every time I go to a conference, we produce our benchmarking report every 2 years, and everyone's always waiting for it. So, first off, it's the only report that exists in Canada that provides benchmarking data in the wealth space at this scale. So, I think that's one of the reasons. So, the credibility and scale really contributes to why. This report is so important. It's actually going to be a decade that Sun Life has been producing this report. We produce it every 2 years, and next year is going to be our 10-year anniversary of this report. So we're really excited about it. Why it's so important is because it really provides a landscape of a member's retirement journey from accumulation and throughout retirement as well. So over the years, we've really evolved this report. It started off as just looking at member behavior and benchmarking data during the accumulation phase. And then 2 years ago, we've added a decumulation section. We thought it was going to be a spotlight, but it became actually a permanent section in our benchmark report. So it really, maybe I'll look at it from an employer point of view. It provides benchmarking data for employers to see how they're tracking their plans towards their peers and their industry. So if they would like to make a change to their plan design, get member better outcomes, I should say, well, this report actually shows the trends to see what's working and what's not, and to have those important conversations. And for advisors, it takes the guesswork out of things. It has real data and insights that they could provide their clients with recommendations on continuing plan designs at work or modifying. So it's really the backing of these numbers at scale and the trends and insights that we highlight. The design for savings is more than just workplace savings. We also look at current market conditions. So in our last report, when we launched the report, there was considerable market activity with the tariffs and all that fun stuff going on. So we actually took a look at the market volatility, and we looked at member behavior and see how they were reacting to that. So we were able to identify some trends. But one of the things that's been an ongoing trend is that workplace savings plans throughout the years have been resilient to market volatility. And that's one of the backbones of this report, to have those important conversations.
Perfect. And Caroline, I have to say this, as much as I love Sun Life's designed for savings, I don't want my other carrier friends to think I don't love them. So let's get it straight. I love all my carrier partners, and I'm nice to all of them, and they all do different things really well. So kudos to Sun Life, but everyone has a role to play. Joking aside, Jackie, I just double clicking a little bit further into the report. One of the things that I've noticed, since you've been bringing them out every 2 years, is the plan sponsor matching is improving throughout the journey. And I've noticed the number of plan sponsors that match at 100% or maybe even higher get larger and larger. I'm just wondering if you can comment on that. And I know it may be obvious, but what does plan design, and how do plan design features and how you create it support the retirement readiness and outcomes for plan members?
Yeah, great question, Raheem. And of course, the plan design is the foundation to workplace savings plan. So a good plan design is obviously going to contribute to better member outcomes. Now, in our last report, as you mentioned, 65% of our CAP sponsors offered 100% match, which is rising, and that really helps members. During resilient times, we've monitored activity post-COVID, as I just mentioned, during market volatility. So when tariffs were mentioned and everybody was afraid of what's happening, our workplace plans were resilient because of that match, and it helps employees get through those difficult times. One of the things, though, the trends that we have seen, and we talked about the evolution of workplace plans. Traditionally, matches went into the DC plans and then RSP plans. So one of the observations we've seen in our last report is that plan sponsors are offering a match in optional plans like TFSA. So that's a new trend that we've been observing. And this is where I feel like we have been referring to the retirement industry, but want to kind of change that narrative to really the wealth industry, because it's no longer plans just for retirement alone. I think shorter term goals and broader goals are very important, and part of the retirement journey, even though retirement is the end objective. So we have seen this trend, more TFSAs offered and a match going into the TFSAs. So this is a trend that we will continue to observe and see how that goes. And I just want to add, when I say resilient, the contributions have been increasing as well. So the average mean contributions have been outpacing inflation. So in our last report, the contributions, both employer and members, had increased about 8%, whereas inflation was about 6.4%. So it's great to see that the contributions have been outpacing the inflation. So it's definitely more money in the pockets of plan members.
Hearing this feedback with the data, because I know Rahim and I, we've been talking and interviewing a number of amazing guests from all carriers, as you said, all suppliers, but like it's really encouraging to hear the theme that flexibility of savings, like for short term and long term, is happening, and that higher contributions and matching is also happening. That's really amazing to see in that data. It's very much showing that employers are listening. They're listening to their employees and their plan members in helping them be part of that flexibility and what you need in your life at this moment. So let's talk a little bit about the investments further themselves. So target date funds are now representing 42% of all member assets, and that's really substantial growth. What would you say is driving this?
Thanks, Caroline. Well, let me just, if I can comment on design for savings, I just wanted to thank you and Rahim for the comments, and just say that we're always looking for new areas to review, and to your listeners and our plan sponsors in the industry at large. If there's sort of burning issues, we definitely want to hear that, and we'll look to add some of that information to the extent possible in our next reports. On the target date funds, yeah, we've definitely seen a significant uptick. It's an increasing trend over the past number of years. I think part of that is target dates have become the de facto industry standard when it comes to the default option. We see over 80% of sponsors now use target data as the default option, and it's a good option. I mean, it provides professional asset allocation, automatic de-risking, and it sort of mitigates timing errors, and there's a lot of diversification within those funds. And yeah, 42% of total assets we see now in target date funds. They've also generally been a good option. They've performed reasonably well over the past number of years. And especially when we see high volatility, like we saw sort of in Q1 of 2026, they sort of mitigate to a certain extent the amount of sort of market timing and sort of reactionary investment decisions. And that's when you're looking at a long-term investment like retirement savings, that's a good thing. I would, however, say that in my view, just because it's in target date, it is important for the individual member to monitor and see and understand how those funds are performing, and also for the employer to ensure that the funds, in collaboration with their providers and advisors, that the target date funds are performing in accordance with what the plan or what they were put in to do. But I think all those things are done properly. They're a great option. Great option.
I just wanted to ask a question about target date. I'm wondering, do you have any data around the type of target date funds that plan sponsor are choosing? What I mean mostly by that is a passive versus an active overlay. I'm wondering, does Sun capture any of that? I forget whether you do or not.
Yeah, I'm gonna tag Jackie in just a sec, but what I will say is definitely target date funds with an active overlay are becoming increasingly sort of popular, common as a way, especially when you think about the past number of years to sort of um, take advantage of market sort of performance. So we're definitely seeing that. We're getting more requests for that on a platform, and more sponsors taking us up on that. I don't have the exact numbers, and Jackie, uh, please jump in if you do.
Sure, Rahim. We do have that data. For the sake of design for savings, though, we have just target date funds. We've grouped them all together. But yes, we can get that data apart from the report.
Okay, perfect. Caroline, I think you wanted to add to something.
Yes, I think you brought up a really good point earlier, and I know that a lot of listeners or maybe employers that don't have a current savings plan at all today. So I thought we might take the opportunity and put you on the spot, Raheem. When we talk about target date funds, can you explain to our audience what are those? How do you usually explain that to employers?
Yeah, I think Joe did a pretty good job of kind of telling us what they are. So the way I explain it to clients is I start very basic and I say, 100 years ago when the mutual fund came around, it was the ability for you to, have a lot of different stocks. So you're owning a piece of many different companies into one vehicle. So you got diversification that way, and you could buy something, with $1 get shares across the board. And then we got a bit smarter and we did that we had a balanced fund. So we had stocks and bonds together. And then we got a little bit more smarter and we said, why don't we have portfolios that have different risk features, right? So we added multi-asset portfolios that the plan member could choose based on risk. But we know people usually don't invest that way. The average person, when they buy a portfolio, they tend to be in that. So target date fund solves our problem where we could have a multi-asset portfolio that de-risks every 5 years or whatever the vintages are, so that a younger person proportionally, because they can afford to be in risky assets, they would have a portfolio that's entirely in all equities. And as that same individual goes from age 25 to 30 to 35 to 40, they sell off stocks in a reasonable way and buy bonds to dampen the volatility. Plan sponsors love that because, most people that work for Canadian corporations are likely not to be investment experts. So we in the industry we call it set it and forget it investing. So that's the way we would explain what target date funds are to a plan sponsor. And as the data shows, I think you have another data point, Jackie, somewhere in that report where 40 is overall the assets, but on a new plan, it's likely to be over 80%. So when you offer a new plan, target date funds will likely take up more than 80%. And I could tell you anecdotally that is the case. Absolutely. Game changer for our industry. People have some negative comments around target date, but overall, I think they've been really helpful.
Looking further into the data, it's showing that the digitally engaged members have dramatically higher account balances. And that's got me really curious. Can you walk us through what digital engagement actually means and why this matters so much?
Sure, Carolyn. I'll take this one. So, as I mentioned, Design for Savings, we created a brand with that name. And under that brand, we launched a report called Digital Engagement. And post COVID, there was an acceleration, right, of everyone hopping. I mean, we had no choice to get on the digital bandwagon. So, we really wanted to see what that difference made in terms of workplace plans. So, if digitally active members, how better off were they doing with those that were not active at all? And the results were quite striking, I have to say. So we did look at four different profiles. And again, this is workplace plans, right? So it's not like bank accounts where everybody's going in every day. So we had the most active members, we had highly engaged, those that went in maybe once every quarter and less engaged, and then the ones that were not digitally active at all, because there's still some people who prefer analog. And digital engagement has actually accelerated because now you're able to do a lot of things on your phone, on your mobile versus your laptop. So this takes into account both activities. And when I say the results were striking, well, the digitally engaged members, 230% higher balances than those that were not engaged at all. So that's a significant difference in savings. So that's just one data point, but there's many others that show even more promising results. So there's stronger contributions all around. So digitally engaged members are contributing 20% more, and they're 3.5 times more likely to make a lump sum contribution. That's significant. Apart from the contributions, they're also less likely to make withdrawals. So 54% less likely to make withdrawals than those that are not digitally engaged. And then not leaving money on the table, the employer money, they're 2 times more likely to take the employer match. And the last one also is not just about money, it's just a peace of mind. So they're more likely to designate a beneficiary compared to those that are not. So 80% of our digitally active members are more likely to designate a beneficiary. But apart from that, we've actually explored more of the data. It builds a lot of confidence for members. So, and with confidence, they're getting better member outcomes. So we're able to just provide the nudges we need. They can see a roadmap. They could see the progress. So it's not just going in and looking at their balance, but it's really getting them to take the actions that are relevant for them.
Can I just top up there, Carolyn? Is that okay, or Raheem?
Yeah, go for it.
This stat floored me that we see with digitally engaged members, and I think it's an area that we're really doubling down on here in terms of increasing our digital tools to members to really capitalize on what we see as a really positive trend. And when you look at digital engagement plus use of planning tools, the numbers increase even further. So it's a big focus for us in terms of really driving member outcomes.
That just screams to me the importance of the employee education, right? Of these tools, of the mobile app, of doing all this. There's great benefit in spending time up front on showing them and walking through these tools. Yeah.
Yeah, agreed. So Jackie and Joe, one of the things that's really interesting, and I think you alluded this to earlier, we don't give it as nearly as much attention as it deserves. We focus on the journey to 65 or whatever, wherever the average person retires. But I think what we don't focus on so much, and as we should, is what happens when we start drawing down on these assets. Hopefully we have, a third of our lives in retirement. And I think you mentioned earlier you've started to do more work around decumulation. Can you give us a few highlights and lessons learned on what the data is telling you with respect to how members are drawing down on their assets?
Yeah, absolutely. So I will just say that, decumulation has been called the hardest problem in modern finance. I think it was Bill Sharp that said that, and you can kind of understand why, right? Like there's 4 major variables that an individual has to predict or navigate or think through as they think about their decumulation journey. Their longevity, sort of the returns and the sequence of the returns, inflation, and then their healthcare needs. And those are really, really difficult variables to sort of contemplate for the average person or any person. But when you step back, we took a look at that and we're like, as an insureco and life co, we have, and a leader in GRS, we have the tools and capabilities to help in those areas. And so that's why in the last couple of years we've really doubled down on our nation on help members. And so we do have some interesting stats to your point, Raheem. So around 45% of members have started keeping their assets with us as they move through decumulation. And what we're seeing is the volatility around those 4 variables in the market actually drives member behavior. So when you see high inflation or volatile returns, members actually scale back and take less out of their accounts to protect against those variables. And the question is that the right decision or not? And it's a very personal decision. But we're looking into that, and we continue to double down in this area because we think it's hugely hugely important for members. What I would say, and where we're going, is increasing the planning tools around decumulation that we offer these members. Because back to sort of the first question that you asked, Raheem, around the Canadian system, like the workplace plan is a massive component of that. But you also have CPP OAS and your personal savings. And it's really, really important when you're making a plan in decumulation to think about all those three levers and make decisions based on a holistic of that CPP OAS, depending on how many years you've worked, gives you sort of that defined benefit type floor, sort of sort of some confidence in the minimum. And then you're using sort of the personal savings in the workplace plan and how you decumulate that to drive sort of the income that you need for your retirement, whatever that retirement needs to look like. We think it's a huge area. It's a way for us to continue to help Canadians maximize their retirement savings and vehicles. And so we're continuing to invest in that area because we do believe it's very, very important. But yeah, thanks for the question.
Great. Well, I can't believe how quickly this conversation has gone by today. But as we wrap up, I'm going to ask each of you, what are your biggest takeaways about the state of the Canadian workplace retirement plans, and what should plan sponsors, employers, and members focus on going forward?
So the design for savings is, as I mentioned, benchmarking. And we actually wanted to take this further to see what are the motivators for plan members. So why do they actually make the decisions that they do? And this is a report that we recently launched called Member Mindsets. And that could be another podcast for sure. But I think the takeaways are just very, very insightful from this report. Unlike past research where we focused a lot on financial literacy. Financial literacy is really important. Financial education continues to be really important. But one of the real powerful motivators that has really been moving the trigger has been confidence. So building member confidence. And we saw member confidence, two actions that really helped improve. And one of them was having a digital retirement planning tool that's easy to use. So when members can see their progress strategies online, the results were really, really very impactful and coupled with advice. I think these days people are getting information from a variety of sources, social media and even AI, I should say. But getting proper advice is coupled with having the right digital tool is really building confidence in plan members, and that's really driving better actions. That's one takeaway I would say for plan members, plan sponsors, because we spent a lot of time and it's still important, education and financial literacy, but confidence is not something we've always looked at. And that's actually really helping move the needle.
Yeah, thanks for the question, Carolyn, and the opportunity to wrap up. It sounds like a simple answer, but just in my experience, members that contribute sort of early and often, as you would expect, have the best outcomes. And so to the extent an individual can, depending on their personal situation, that would be my key piece of advice. And then from a sponsor perspective, where we've seen sort of differentiated or outcomes is making sure that members understand all of the aspects of the programs that are available to them and provide the planning tools, digital or otherwise, to help them optimize and get the most out of your programs. So they are delivering great outcomes for your members as a sponsor, but also a competitive advantage for you as an employer.
Okay, great. And Raheem, from the advisor perspective, any final takeaways from this episode?
Yeah, I think I'll go back to the way we started with the Canadian landscape, and it's really worthwhile mentioning, and I'm glad Joe did. We have a really good baseline in Canada with CPP and old age security. It's a world-class system to begin with, so we have a nice floor, and we have to give credit to employers. They pay into CPP along with members. Now we are asking them to do more. We are asking them to spend more money on a traditional GRS plan, and we focus on cost. But I'll give credit to Joe, and this is the way we want to do it, is we want to make the wording be an opportunity for them, an opportunity to do right by their plan members and their employees who they really care about. Caroline, I think I've mentioned it before. We had a client where people who worked with them for 25 to 30 years did not have a plan because the plan sponsor, the owner, always thought that having a retirement plan meant a DB plan. until he met with us and we let him know, no, you could do a defined contribution, you could do a group retirement savings plan. And they felt so bad because they spent 20, 30 years having a great business with employees who became a part of their family, but these people had no money in terms of retirement savings. So ever since that client example, I think when we provide education, we take it for granted. The more outreach we do and the more we explain how a small SMB business can have a plan that they can call their own that will help their plan member, I think it's an opportunity for these business owners to do something incredible for their employees. So that, I think we already have a great backbone and we continue to be leaders on a global scale. And having data the way we do with Design for Savings, it allows us to tell the plan sponsor, hey, you want to be competitive. Here's what other corporations in your sector are doing, right? Do you want to be a plan that's a Cadillac plan, or do you want to start small, right? And the data driven insights really help us do great by our job. So it's thank you to Sun Life and everyone else who's giving us this data so we could do our job on the client side of things.
Great place to wrap up. And yeah, data certainly provides opportunity. Knowledge is power, and helps provide guidance and advice. So thank you, Joe. Thank you, Jackie, for joining us today.
Thank you,
Thank you for
Carolyn.
having us.
This has been the Benefits Alliance Voice. If you enjoyed this episode, please share it with your network and be sure to check out the podcast notes for any additional materials.